Strengthen your understanding of governance and policy design. The 12-week graduate course in public policy begins 10th January 2026. Apply by 30th November 2025 to avail a 10% early bird scholarship.
Welcome to All Things Policy, a daily podcast by the Takshashila Institution. We are a bunch of policy nerds based in Bengaluru, and we like bringing fresh perspectives to Indian affairs and Indian perspectives to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Welcome to this episode of All Things Policy. I'm Vanshika Saraf, a research analyst with the Indo-Pacific Studies program. And today I have with me a very special guest, Sriram Iyer. Sriram is not only an alum of our graduate course in public policy, but he's also the managing director and CEO of one of the largest pension fund management firms in India. Sriram carries close to 3 decades of experience in the banking and financial services sector. He's played leadership roles in the capital markets industry, and very importantly, he is passionate about spreading financial literacy and has conducted numerous financial awareness sessions. Thank you so much, Sriram, for joining us today.
Entirely my pleasure, Vanshika. It's glad to be here with you.
Thank you. So today we're going to discuss pension policy in India, the governance challenges and the future pathways of India's pension ecosystem. And one of the reasons I really wanted to do this podcast, because I've come to realize that, pension is as much a public policy issue as much it is a personal finance issue. And one of the peoples that, is in India is extremely foundational on pensions is Ajay Shah. He's a leading economist. He's been extensively involved in creating the new pension system as well. And so while preparing for this podcast, I was reading some works by Ajay Shah, who at one point was also a former consultant to the Ministry of Finance. And in 2005, he wrote this paper that I think is a very important reading on why pensions matter. And he makes some points. First of all, he says poverty amongst the elderly is the next frontier, and sort of the breakdown of joint family also accelerates that. And the only solution to that is a sustainable and scalable pension system. So he focuses on these two key words that he thinks are essential in thinking about the pension system: sustainability and scalability. Because it's possible to design non-scalable programs which work for a few people. It's also possible to create subsidy programs which are unsustainable, only last a few years. So one of the biggest challenges of India is to create a framework which reaches not only a substantial part of the population, but those below median incomes and for a long time to come. So with that background, Sriram, to begin, could you give us an overview of the national pension system, perhaps a bit of history, the shift from the old to the market-linked new system? I'll leave it up to you.
Excellent. That's a fantastic start because Ajay Shah is somebody that I follow very closely too. I look up to him because he's one of the, incidentally, he was a part of what is called as the Oasis Committee, which is Old Age, Social Income and Security. That was the committee that was set up by the government of those times way back in 2000 to sort of come up with a design which would sort of replace the defined benefit pension system that existed for government employees. So if you recollect, prior to Jan 2004, any employee who joined the government service, and that's one of the reasons why government jobs were very sort of sought after, right? You had this defined benefit system where you were eligible for a certain pension, which was a function of your last drawn salary, and then there was a it's called the dearness relief component, which is essentially pension adjustment as well. Not only was it indexed to cost of living, but it was also indexed to the wage of the person when he retired. There was a certain basic that the person would have been drawing. Any revisions in that basic in pay commission would also get impacted on the the benefit would come to the pensioner as well. So I think it was a very, very sweet deal from a government employee's perspective, but clearly unsustainable and could have potentially pauperized us, and we would have been in a very different situation today had national pension system not been implemented. So I think Ajay Shah has played a played a very, very huge role, and his inputs and his insights and of course his papers is something that I have followed, and I've had the good fortune of meeting him, spending time with him, exchanging thoughts with him, and I think he clearly brings a very, very clear and nuanced perspective to this topic of pensions and why it is such an important topic for us in India at this point of time. So, to your question, cutting to chase, to your question on the background, so essentially this was a replacement to the defined benefit pension plan that existed for government employees. I'd like to highlight that this started as a pension plan only for government employees. So it essentially launched for central government employees and then subsequently for state government employees starting from Jan 2004. And any employee who came on and joined the government service after that particular date was eligible for what was known as the National Pension System, NPS. That's the genesis of this. In 2009, the government realized that this may be a very meaningful vehicle for the all citizens or the unorganized segment, as you call it, the non-government sector, which is essentially both self-employed and non-government salaried individuals. The need for a pension plan for this segment, while there were some insurance company led pension plans, and there were some mutual funds which used to sort of launch retirement plans, but there was a need for this national pension system to be opened up to a wider universe of, let's say, eligible participants. And that's how in 2009 it got opened out to what is known as an all citizens framework, which meant that any Indian could participate in the national pension system by contributing to it. And then subsequently in 2011, there was a variant of this which was launched, which is called as the corporate NPS, and we will get to some of the details on corporate NPS, and that was specifically targeted at salaried individuals, and there was a specific tax dispensation that continues to this day, and that's a very compelling tax dispensation that is available for salaried individuals for contributions that they make to corporate NPS. So that's the background. Vanshika, I hope that's sufficient, or we can get into more details
Yes,
as we.
yes, absolutely, yes. So yeah, just following up on that, since we're still at that topic. So from a policy standpoint, what were some of the exact problems that the NPS was designed to solve? One, which I think partially you've answered, and how well do you think has it performed since it's been introduced?
So the answer for this is a mixed bag. So if you were to look at the government sector, the intent behind this was obviously to, as I said earlier, to sort of replace the defined benefit system with the defined contribution system. Obviously, the government succeeded in doing so. And I think we must credit the government of those days. Actually, there was a change of guard between NDA and UPA at that point of time. And irrespective of that, there was a bipartisan support for this reform. And that came about because both the ends of the political spectrum agreed on the fact that this could potentially be a massive problem if we don't address it. And I think full credit to the dispensation at that point of time to have actually pushed this through and implemented it. Now, if you therefore look at whether it has worked for us, I would say the answer is a yes and a no. The reason why I say that is because if you look at the government sector, if you, of course, there is a legacy employees who were in employment prior to Jan 2004 who are still beneficiaries of the old pension system, but those numbers are coming off, right? Those numbers are obviously shrinking because those employees have retired, and that cohort of individuals have pretty much sort of got exhausted. There are, of course, a few of them who are at very senior levels and probably in the ages of 55 and 58 who potentially will be still beneficiaries of the old pension system. The new pension system, or the national pension system, or NPS as it is called, there are 27 lakh central government employees who are now the beneficiaries and who have joined post Jan 2004. So they are all beneficiaries of the NPS. Similarly, there are 67 lakh employees in the state governments across all the state governments that have implemented NPS. And there are, like, we can talk about, which states have implemented, which haven't. But suffice to say that the majority of the Indian states have implemented NPS. And so between the 67 lakh state government and 27 lakh central government employees, there are close to 1 crore government employees who now form a part of the NPS. So yes, to the extent that it was targeted at the government employees and to solve this problem of this defined benefit, pension system which existed prior to Jan 2004, it has obviously solved the problem, to a very great extent. And we can get into the unified pension system, which is unified pension scheme as it is called, which got launched earlier this year in April of 2025. We can get into some of those details and how it is a sort of a combination of a defined benefit and a defined contribution system and how that came about. Get into that slightly later. But the reason why I said yes and no is that no pertains to really the non-government sector. If you look at the adoption of NPS amongst the non-government sector, I think we've still got a very, very long way to go, right? If you look at the numbers, the most updated numbers that you will see are October end. You could say September, October end. The total number of Indians who have an NPS account today are around 72 lakhs, 7.2 million, right? Now that's a spec. If you look at the overall number of people who are in formal employment, which is estimated to be in the region of around 9.5 to 10 crores, and then there is this very large unorganized sector of close to 40 to 45, 50 crores. That is the universe of people that should ideally form a part of this national pension system kind of a pension plan. Of course, one could argue that there are around 7 crore members on the EPF, which is fine. But I think there is a very large segment of the population which are at this point of time completely, there is no form of old age income security that exists for a very large segment. So to that extent, no. And therefore, I think there is a lot that we have to do as a country to make sure that we have more and more people participating in, let's say, a efficient market linked vehicle like NPS. So that's really my answer, right? Yes and a no. Yes, as far as the government sector is concerned. And I would say there's a long way to go when it comes to the non-government sector.
Yeah, in fact, that was one of my questions later, but since you've brought it up, I had some percentages, and correct me if I'm wrong. It says that less than 12% of India's workforce is covered by formal pension mechanisms, and over 85% of informal workers, as you said, remain excluded, which sort of highlights the inequality, right, when it comes to retirement security. So we can come to more about how we expand this coverage to the informal workers who remain excluded from the structured saving systems, as you mentioned. But before that, perhaps, since you also mentioned how some state governments have it, some don't, and sort of this tussle between center and the state, could you walk us through the core institutions that govern this sort of entire architecture? So, like the PFRDA, pension fund managers like you, annuity providers, POPs, and how do these collectively maintain the ecosystem?
Excellent. I think the reason why we must dwell on this point is because of the fact that it is distinctly different from other financial product, the architecture of other financial products that exist in India. And I think to that extent is a very important question. And I think I'm glad that you asked this question. And there are multiple entities that form this overall pension fund ecosystem or the NPS ecosystem in India. Let's start with PFRDA. The PFRDA, as the name suggests, is the regulator and is responsible for essentially two things. One is, of course, regulating the pension sector, making sure that the pension fund managers, the points of presence, and the other intermediaries in this NPS system are adhering to the regulations that have been drawn out under the PFRDA. Under the PFRDA Act, there are regulations that have been drawn out for each of these entities, and the PFRDA's responsibilities is to obviously make sure that everybody sort of aligns to those regulations. I think the bigger task that PFRDA has is the development task. And I think that is something that PFRDA, we must credit them for their very active engagement and involvement with the industry, especially in the recent past, to make sure that there is much greater adoption of NPS across the non-government sector. And I think that's something that PFRDA, has played a fairly active role in. I think it's a joint responsibility between the intermediaries in the industry and PFRDA. So that's what PFRDA does. So PFRDA essentially is responsible for making sure that all of us are managing the monies by the book within the regulations that have been prescribed, and making sure that they are able to incentivize and drive adoption of NPS amongst Indians. So that's the broad agenda that PFRDA runs with. You spoke about pension fund managers. I work for a pension fund manager. You spoke about it earlier. I work for HDFC Pension. We're the largest pension fund managers in the national pension system architecture amongst the private sector players. There are 9 more players. So there are in all 10 pension fund managers that have been licensed by the PFRDA to manage NPS monies. So that's the second entity. And essentially, the pension fund manager is expected to manage the monies that have been entrusted to them by the subscribers as per the guidelines and regulations laid down by the PFRDA under the investment guidelines. The third entity that you referred to again was the points of presence, and the point of presence is a very interesting concept, because when you talk about a point of presence, people are really staring at you, almost glazing over, saying, "What does this mean? What is this entity?" Essentially, a point of presence is an entity which is responsible for driving adoption of NPS. So the company that I work for, the company that I manage, HDFC Pension, is not just a pension fund manager, but also a point of presence, and the largest point of presence on the corporate NPS side. So there are in all over 100 points of presence in the country. These could be pension fund managers, or these could also be banking institutions and financial services entities which are responsible for or which have been licensed to distribute NPS as a product, right? So a point of presence is a licensed entity licensed by the PFRDA to distribute national pension system, right? So that's what the point of presence is. A point of presence, a pension fund manager may or may not hold a point of presence license, and that's just a matter of choice, or that could be a matter of regulation as well, because there are some of these pension fund managers whose parent company is regulated by, let's say, one of the regulators, which does not permit them to hold a POP license or the point of presence license. So that's just a bit of an aside. But by and large, there are over 100 points of presence. This includes all the large private sector and public sector banks. It includes some of the other financial services distributors that are there in the country. And of course, there are some of us amongst the pension fund industry who are also points of presence, right? So that's the third type of entity. The fourth type of entity is what is referred to as the CRA. The CRA, or the Central Record Keeping Agency, plays a very pivotal role in the NPS architecture. Mind you, NPS architecture is referred to as the unbundled architecture, right? This is one of those unique features about NPS where each entity that we spoke about, I spoke about PFRDA, PFM, POP, CRA, and I'll talk about a couple of more. Each of these entities are expected to play a certain role, and that's a specialist role that they're expected to play. So therefore, a pension fund manager is exclusively responsible for managing money. A point of presence could also be a pension fund manager, which as I said, in our case is the case. But more often than not, points of presence are standalone entities which could also be responsible for only driving adoption of NPS, and they could of course be distributing other financial products as well. The CRA is the entity responsible, or the Central Record Keeping Agency is the entity which is responsible for maintaining the records of all NPS subscribers. So they are really the backbone, in some sense, the operating backbone, for the NPS ecosystem. So all the records are maintained by CRAs. So as a subscriber, you basically talk to the CRA to access one's record. So the CRAs, there are 3 CRAs as we speak. 3 of them are licensed to operate in the NPS ecosystem. The choice of CRA is left to the subscriber. The pricing is the same across all 3, marginal difference, but pricing is regulated by PFRDA, and therefore to that extent there is really no major difference. But all of them offer a certain set of capabilities. Some of them offer an app, some of them offer various other add-ons, but essentially that's the backbone. So that's the CRA. Then there are annuity service providers. Annuity service providers in India happen to be life insurance companies only. Annuity service providers are those that are responsible for offering annuity options to subscribers once they exit the NPS ecosystem. So as you will know, NPS at the age of 60, which is the superannuation age as it is called, or at the time of, let's say, somebody wanting to exit the NPS ecosystem, there is a certain percentage of the corpus that comes out that has to be used for purchase of an annuity, right? And the annuity is typically issued by an annuity service provider, which in India is only a life insurance company. And that's what an annuity service provider does, which essentially is to help the customer create a series of cash flows using the corpus that the customer would have at the time of exit or maturity, as the case may be. Finally, there are, of course, a couple of more entities which we don't need to get into too much detail. There's a trustee bank which manages all the cash flows, and then there is a custodian who is responsible for holding the securities as in their custody. One final entity that I want to talk about is National Pension System Trust, NPS Trust. This is the body which has been constituted by PFRDA. NPS Trust is nothing but a common trust entity for all pension fund managers. So the subscribers' securities are held in the name of NPS Trust. Similar to, let's say, a mutual fund industry where there's a trustee company that is there in every asset management company. In the case of NPS, there is one centralized entity called the NPS Trust, which has its own board of trustees, which has a CEO, as a full operating entity, and they are also responsible for monitoring the performance of pension fund managers and alignment to the regulations that have been issued by PFRD. I think I've pretty much summarized the 6 or 7 intermediaries that exist in the pension fund the NPS architecture.
Yeah, that was very comprehensive, Sriram. Thank you so much. Just for our listeners, annuity basically refers to the fixed monthly pension that you would like to draw based on the lump sum, right? And just a follow up question, since you mentioned LIC, Sriram, does NPS have any equivalent of LIC agents who sort of actively sell the product? Is there any equivalent to that?
Two clarifications. One, an annuity could potentially be monthly, quarterly, half yearly, annually, right? So one could draw out.
Right.
So what does an annuity do? Essentially, an annuity, you basically exchange a fixed cash flow with the annuity service provider for a series of cash flow till one is alive, right? So it
Hmm.
essentially takes away the longevity risk from the individual, so the annuity service provider essentially takes on the longevity risk on their own books and guarantees you a certain fixed payout at a frequency that you desire, right? So it's a
Right.
decision that you can make. Now, similar to life, when you said life insurance, I said LI companies, I said life insurance companies, not life insurance corporation, life insurance companies. So there are, like in agents that exist in the life insurance business, there are what are called as pension agents that are either regulated by, they're actually appointed by the points of presence. I told you about points of presence as
Yes.
distributors of pension NPS. These points of presence could appoint individuals as pension agents, individuals or corporate entities as pension agents, and these pension agents are essentially work under the umbrella of the point of presence that they've signed up with. So the answer to that is yes, but the numbers of pension agents in India are nothing compared to the number of insurance agents that exist in India. So
Hmm.
comparison is sort of, in some sense, there aren't enough pension agents in India for various reasons, right? I can get into that, but yeah, you're right. So to that extent, yes, that channel of distribution does exist.
Hmm. Right. I think that clarification is extremely important. So coming to a bit more about the PFRDA, in the last few months, it's announced a number of reforms. And so would you like to elaborate on some of these and maybe some other reforms that are on the anvil?
Certainly, certainly. So I think the last few months have actually seen a flurry of actually changes and reforms that have happened in the PFRDA ecosystem. Now,
Hmm.
in the NPS ecosystem. Now, one of the big changes that have been introduced, which is referred to as the 22 Section 22 of the PFRDA Act. I don't want to bore you and bother your
Hmm.
listeners with the sections, but it is important to highlight this. Under a particular provision of the PFRDA Act, the PFRDA is allowed to, recommend or can allow pension fund managers to launch schemes on their own. So under that section, what PFRDA has done is essentially allowed pension fund managers to launch schemes on their own. I want to sort of explain this a little bit, because you might wonder as to what it really means.
Sure,
This has
sure.
been this has been this has been permitted under what is called as a multi-scheme framework, and it is referred to as the MSF reforms, multi-scheme framework. What does multi-scheme framework essentially mean? It essentially means that an individual subscriber thus far, and I'm going to refer to a date prior to 30th of September or October 1st of this year, when an individual subscriber could hold one type of asset allocation or one type of an investment strategy. So let's say you were an NPS subscriber, you had the option of course, you have multiple options within the NPS ecosystem in terms of what investment strategy you follow, but you were essentially able to do only one structure. Let's say you chose 75% equity, 25% fixed income.
Hmm.
That is where your money would go. Your legacy money would be 75-25. And of course, the percentages could vary depending upon how the market moves. But essentially, you held one scheme. Under the multi-scheme framework, what it now allows an individual to do is to be able to hold multiple such combinations. Not only does it do that, but it also allows in the same breath, it also allows pension fund managers to launch schemes of their own. So before 30th of September or before 1st of October 2025, the maximum, I'm just giving you an example of some of the changes that have happened in the new schemes, or the multi-scheme framework as it is called. So two big changes. One, allocation to equity prior to 1st of October under the what is referred to now as the common schemes could have been at best 75%. So as an individual subscriber, you could take an exposure of up to 75% in equity. You couldn't exceed 75% allocation to equity. You could, and the remaining 25% had to be in fixed income in the form of government securities and corporate bonds. Under the multi-scheme framework, pension fund managers, as I said, have been allowed to launch their own schemes. So people like us have launched schemes where one could have allocation up to 100% in equity, right? So one, it therefore takes away the cap of 75% that existed in equity. That's one big change. The second big change, other than the fact that as an individual you can hold multiple schemes, the second big change is that thus far you could exit from NPS. Of course, there are some premature exits that you could do, but it was meant to be exited only at the time of superannuation, right? Which was either age of 60 or 58, as the case may be, depending upon the corporate that you're working for. And if you're a self-employed individual, you could exit from NPS at the age of 60. The new schemes have been allowed to create products where the vesting period is 15 years. So which means that somebody at the age of 30 can potentially exit if they participate in one of these newly launched schemes. And if that scheme has a vesting period of 15 years, then the individual could potentially exit from NPS at the age of 45, assuming they got in at the age of 30, and so on and so forth, right? So there are three big changes. One, an individual could hold multiple schemes. Therefore, as an individual, you could say that I will create a ladder of cash flows, or I could create investment. I could participate in multiple investment vehicles to take care of different needs that I may have, different milestones that I may have at different points of time. And therefore, it offers more flexibility to the individual subscriber. Second, as I told you, the pension fund schemes that are launched now have allocation of up to 100%. And third is the fact that you can actually, get out of the NPS ecosystem, or exit from NPS after 15 years, or superannuation, whichever is earlier, right? So these are three big changes that happen. What is referred to the multi-scheme framework. Now, I think this is just we've sort of just about getting started. There are a slew of other reforms that are at this point of time under consideration. Some of them have been released in the form of consultation papers, and those pertain to the exit from, NPS. There are certain requirements at this point of time. NPS, you need to have, when you exit from NPS in normal course at the age of 60, or at the end of 15 years in the new schemes, 40% has to be used for purchase of an annuity compulsorily, right? That is being relooked. So the 40% could potentially come down to 20%, which means that individuals who exit could potentially take home 80% of the corpus, accumulated corpus, and only 20% needs to be used for purchase of an annuity. And the second thing is, of course, the fact that for certain quantum below 12 lakh rupees of terminal corpus, or the accumulated money being 12 lakhs or below, you don't need to buy an annuity at all. You can actually do what is called a systematic unit redemption over a period of 5 years, and the money, the entire money comes to you. So I think this is the second set of reforms that have been unleashed. There are also certain enablements that have happened. So, for instance, there is something called the e-Shramik, or the platform workers model that has been launched. Under the platform workers model, this is essentially targeted at employees of gig companies, either the delivery workers and various other self-employed people who work on all of these platforms. There is a scheme there's a platform that's been launched, which is called the NPS platform for platform workers. Here, the minimum contribution amounts have been brought down to as little as 50 rupees, right? So there are a number of things that have happened in terms of, not just this pertaining to the core NPS construct, but also in terms of newer capabilities that are being introduced to make sure that we are able to address a wider segment of the population that is, that really needs to sort of sign up for a product such as this.
Right. So, just one question based on one of the changes that you mentioned, that now there is no upper cap to how much an individual can subscribe to equity in his portfolio. From 75%, it can be, up to 100% now. So,
Yeah.
of course, with equity comes market risk. So, I was wondering, how do you explain this sort of market linked returns and volatility to an individual, and what can one do to protect themselves against such risks?
Two things, right? One, of course, the reality is that, if you look at any pension system, one of the key reasons why a pension system succeeds is its ability to create returns which are meaningful and inflation beating over long periods of time, right? So that's a very important element in any pension system. Now, while equity as a vehicle or equity as an asset class is extremely volatile, the reality is that equity is the only asset class that has the ability, and when I'm referring to equity, I'm referring to a basket of stocks and not necessarily just one stock. A
Right.
basket of equity instruments or equity stocks has the highest probability of helping individuals beat inflation, for a simple reason that when you're buying equity, you're buying into risk. You're buying into the risk of a company succeeding or not succeeding. And what we
Mm.
do really is to try and explain to individuals the fact that in the short term, right? And especially if you look at any pension plans, typically people stay invested in an NPS kind of a product for 15, 20, 25, 30 years, typically, right? I mean, you sign up for a pension
Mm.
plan, you start contributing, and you're essentially going to get out in the new schemes, of course, later, 15 years later, but in the common schemes, you get out at the time of superannuation. So with time, the risk of volatility in equity actually disappears, right? So the risk of actually losing money in equity diminishes with time. So we try and use various sort of examples in terms of what happens if you were invested for a year, what has been the past experience if you were invested for a 3-year time horizon, 5-year time horizon, 10-year time horizon, and so on and so forth. So we keep using various rolling return, periods, so that you're not sort of cherry picking from when to when, but essentially trying to cover all market cycles and demonstrating to individuals as to how, if you held on to a basket of equity stocks, managed equity stocks, for a reasonably long period of time, upwards of 10, 15 years, the probability of losing capital diminishes to zero. This is as per past experience. And the probability of you making a double digit return actually improves to about 90-95%, right? And of course, the longer the time frame that you take into account, the higher are these probabilities. Therefore, using various mathematical, I mean, simple sort of communication nuggets to basically drive home the point that with time, your risk of equity, actually fixed income is a lot more riskier over longer periods of time, given the fact that in a country like India, fixed income rates have been coming down. It will come down as the economy progresses, because that's essentially the way an economy moves from developing to developed. The cost of money goes down, and therefore fixed income is a vehicle that potentially will not help you create reasonable returns. So if you have time on your side, the vehicle that makes most sense is equity, and we try and sort of create various ways to sort of communicate this to subscribers and investors.
Right, right. Talking about time, Sriram. So, in the early, say, 2000s, there's a lot of optimism in the country about, our demographic transition, because there was a substantial decline in the dependency ratio that was expected. And so, a large number of people coming into their working years, for example, me. And so, there was optimism regarding, the opportunity to create a pension system. But, fast forward to today, although, yes, we're still a very relatively young country, we are aging faster than historically expected. Our replacement fertility rates are also, have sort of belied expectations. So, what does this demographic shift really mean for pension planning and fund management, from a macroeconomic sort of perspective?
I think you hit the nail on the head, Vanshika. That's one of the things that keeps us, keeps a lot of, not just us, but a number of policymakers awake, given the fact that while India is an incredibly young country at this point of time, as you pointed out, 29 is our median age. So there's a very large number of Indians who are below the age of 29. But 20 years from now, that's not going to be the case. So from 1 in 12 Indians being, or 1 in, let's say, 11, 10 to 11 Indians being above the age of 60 at this point of time, that number is going to more than double in the next 25 years, right? Which means that
Yeah.
1 in 6 people or 1 in 7 people will be above the age of 60, right? And there in itself lies a serious issue. If we do not, and in terms of just absolute numbers, that number is likely to be in the region of 32 to 35 crores of Indians who will be above the age of 60 by the time we hit the 100-year anniversary of our independence, right? 2047, 2050, right? Give or take. So I think that's indeed a problem that is something that needs to be addressed. The only advantage that we have is that we have time on our side. It's not as if that goal, that that situation is going to occur in the next 5 years. We have 25 years to go before we get to a stage where our demographic, and even then our demography, demography is going to be reasonably okay, but it's going to be significantly worse than what it is today. And therefore it's important for us to take a number of steps from here on for the next 25 years so that we are able to drive adoption of products such as these amongst the younger generation, and make sure that they are adequately provided for, and all the other things that you pointed out, right? I mean, nuclear families, the fact that the
Yeah.
fertility rates have come down, all of these things are going to add fuel to the fire of India becoming an older country, faster than we become richer, right? And therefore it's
Yeah.
important for us to make sure that we get richer faster than we get older in some sense, right? And that's an important element when it comes to looking at policy. The second thing, and you spoke about fund management, and I think what are the implications on fund management? Of course, the reality is that if you look at, let's say, 72 lakhs Indians, 72 lakh subscribers today, and we look at the asset liability, how is it playing out, and how many people are likely to sort of retire in the next 1 year, 2 years, 3 years, 5 years. Let me tell you, a very large portion of these 72 lakh subscribers are likely to retire after 10 to 15 years from now, which means that pension fund managers must carry, and of course the points of presence must make sure, the POPs must make sure that they are communicating the options that are available to a subscriber, so that the vehicle that will make the most sense for them, which is equities and of course other similar asset classes such as InvITs, REITs, and alternate investment, which now also will become a part of our investing universe. People make an active choice for opting for such vehicles which will help them sort of create meaningful retirement corpuses over the next 25, 30 years as they age.
Right. And, something else that I picked up from, Ajay Shah's paper was that mistakes in policies on pension can actually destabilize the entire economy. And he gives an example of, many advanced countries where economic policy is ordinarily executed, very competently, but they're now laboring under pension related debt of over, I don't know, like 100% of GDP.
Yeah.
So, what seems to be micro issues in the pension sector have sort of a disconcerting way of turning into large macroeconomic challenges. So, keeping that in mind, there are examples that probably of countries which have done very well, which have very strong social security frameworks. So, I don't know, are there any lessons that you think India can learn from, say, Singapore or Sweden or in Australia, or any other example that comes to your mind to build sort of a more sustainable ecosystem?
So I think what defines a pension system that is that can sort of stand the test of time. There are three things that are important, right? One is coverage, right? Which means that is your pension system covering the target population that you need to cover, so that you don't have a problem of a large number of people who are not under a pension scheme, right? So that's one big ask of a pension system. The second is adequacy, right? Any pension system that you create needs to be able to address the issue of whether the corpus that has got created is adequate for the individual at the time of superannuation. And the third is
Right.
integrity, right? The system needs to be such, the pension system needs to be such that there is a high degree of transparency, trust, and governance, which is very, very strong. So I think if you examine these three, and look at any pension system with these three lenses, and there are of course shining examples of this globally. Of course, you spoke about Singapore, you spoke about Australia, you spoke about Netherlands, you spoke about some of these countries. There is, of course, Chile. There is, of course, Brazil, and there are a number of other economies which have done things. Some of which has worked, some of which has not worked. Right. But I think the
Mm.
key is to make sure that we learn from some of these examples that have worked, some of these examples that have not worked. Right. So if you look at the way some of these things have sort of played out. There is this whole digital infrastructure that has really sort of come into existence across the world. I mean, in India as well, and the adoption of, let's say, UPI, and the fact that there are 300 billion transactions that happen in a month, and there is such a large, and the ease of use, I think, is something that clearly can be a huge tailwind for adoption of a product such as NPS. And I think as an industry, and as NPS across all of us, right? I mean, the regulator, the POPs, the points of presence, the pension fund managers, the CRA, everybody needs to come together to make sure that, and there is a huge amount of progress that we've made, right? Today, it takes less than 3 minutes for you to open an NPS account. I don't think too many people know about it. It's entirely digital, right? The
Mm.
only thing that you need to have is a CKYC number, which most Indians tend to have. If you have a financial product, then you would have a CKYC number. That's number one. So therefore, ability to make this easily adoptable, if I were to use that word, is critical, right? So therefore, ease
Mm.
of access, ease of signing up is very critical. The second learning that we have seen is that auto enrollment does magic, right? And we've seen that
Mm.
not just in pensions but also in other products like organ donation. And we know all know the examples of organ donation, and how adoption rates went up dramatically when it was sort of auto enrolled, people or auto enrolled in some of these schemes. Pensions is actually an existential problem, right? And therefore there has to be policy measures that almost force an individual, make it mandatory for an individual to start setting money aside for meaningful pensions. I'm not referring to
Yeah.
12% of your basic going there and capped at 15,000. That's not going to solve the problem of adequacy, right? In some segments of the population, there is also a need for us to have matching contributions. Matching contributions are something that other countries have tried. It was worked. In India, the Atal Pension Yojana, as you will know, it's a part of the NPS architecture.
Mm.
There are close to 7 crore Indians who are a part of Atal Pension Yojana. There is some form of government subsidy that is there. So there is, what gets defined there is that you're at a particular age. If you invest this amount of money, this is the amount of pension that you're. So there is visibility in terms of what is the cash flow. But that there is an adequacy problem in APY, because the maximum pension that one can draw per month is around 5,000 rupees. So it's not really too much, but there is some
Mm.
some form and shape of a kind of a subsidy that is given by government. Then there are various other vehicles that one needs to look at. For instance, if you look at the kind of schemes that one can participate in, there are life cycle schemes, right? So how do you make it less of a strain on the individual to make choices, right? So how do you make sure that the default choices are strong enough for people to be able to participate, right? And that's something that we have seen has played a big role in some other countries where adoption has improved significantly. How do you keep it simple? Keep the whole architecture fairly straightforward and simple, such that people there's not enough too much of cognitive load on the individual when the individual is going through. So I think there are a number of things that we've learned from other countries, like the examples that you took. Of course, there is also a very strong need for us to blend the healthcare and health becomes a very the health insurance and sort of medical expenses become a very large part of one's expense one as one
Mm.
ages. So there are examples like, for example, Singapore has got Medisave, which is sort of almost a mandatory contribution that one needs to make. And there are tax deductions and so on and so forth that are available. So I think there are a number of such examples. I think NPS solves for a lot of these as we speak. But I think there is a lot more that we can do in terms of design. And I think all of those, I can tell you, we work very closely with PFRD as an industry, and the PFRD is fully seized of this. A number of these things are in the pipeline, and I'm sure we'll be there's a lot to learn, but a lot of this is going to become a reality in India as well under the NPS ecosystem.
Right. That's very good to know, Sriram. And I think in that answer, you've answered multiple sort of questions that people might have while listening to this, because I think people realize in India that young professionals undersave for retirement, and it's probably, like you said, a bunch of factors. It's behavioral, there might be a trust issue, that income related constraints. We're not a very high income society, but apart from that, also everything else that you mentioned, and some solutions like auto enrollment, that I think can solve part of the problems. So thank you so much, Shriram. This has been a very, very insightful and enriching session, and I think it sort of really helps people realize that pensions connect how economic policy to individual well-being, which of course at youth we take for granted, but this is an issue of governance, of equity, of intergenerational relationships. So thank you so much, Sriram, for joining us today.
Thank you very much for having me, Vanshika. I thoroughly enjoyed this conversation.
Thank you.
If you liked our show, dive into Takshashila's research on technology, strategy, and economic affairs. Check us out at our Twitter handle @Takshashila INST or our website takshashila.org.in.